Welcome to Mindful Trades Academy. In this video, we will be discussing one of the most common psychological traps that traders fall into, the trap of loss aversion. As traders, it's easy to get caught up in the fear of losing money, which can lead to poor decision-making and missed opportunities. But with the right mindset and strategies, we can learn to overcome this bias and become more successful in our trades. So join us as we explore the topic of loss aversion and learn how to become more mindful traders. Let's dive in. Loss aversion is a well-known cognitive bias that affects our decision-making in many areas of life, including trading in the stock market. It refers to the tendency of people to feel the pain of losses more strongly than the pleasure of gains, which can lead to irrational decisions and behaviors. The phenomenon of loss aversion was first identified in the late 1970s by psychologists Amos Tversky and Daniel Kahneman. They conducted a series of experiments in which participants were asked to make decisions involving hypothetical scenarios with potential gains and losses. They found that people were consistently more averse to losses than they were motivated by equivalent gains. Tversky and Kahneman proposed that this bias was rooted in the evolutionary history of human beings. Our ancestors were more likely to survive if they were cautious and avoided threats and dangers. Thus, the pain of losing something, like food or shelter, was more intense than the pleasure of gaining it. This tendency has been preserved in our modern-day brains, which can lead to irrational decisions in the stock market and other areas of life. The effects of loss aversion on trading performance can be severe. In one study, researchers found that traders who were more prone to loss aversion had lower trading profits than those who were less affected by this bias. The study showed that traders who were less averse to losses were more willing to cut their losses quickly and take profits when they had the chance. In contrast, traders who were more averse to losses tended to hold on to losing positions, hoping that the market would turn around in their favor. One of the most famous examples of loss aversion in the stock market comes from a study conducted by Terence Odean, a finance professor at the University of California, Berkeley. Odean analyzed the trading behavior of more than 10,000 individual investors over a 7-year period and found that the average investor sold winning stocks too soon and held on to losing stocks for too long. In other words, investors were more averse to realizing losses than they were motivated by potential gains. Another study published in the Journal of Behavioral Finance found that loss aversion was particularly strong in volatile markets. In these markets, investors were more likely to make irrational decisions based on the fear of losing money. These studies demonstrate that loss aversion can have a significant impact on investment decisions and can lead to suboptimal outcomes for investors. However, there are ways that traders can mitigate the effects of loss aversion and make more rational decisions. Consider a trader who bought shares in a tech company that was performing well. The stock price increased steadily for a few weeks, and the trader was feeling confident in their decision. However, when the stock price began to decline, the trader held on to the shares, hoping that the price would recover. Despite the signs that the company was struggling, the trader continued to hold onto the shares, unwilling to take a loss. Eventually, the stock price plummeted, and the trader lost a significant amount of money. Research has shown that loss aversion affects a significant number of traders. According to one study, up to 70% of traders experience loss aversion at some point in their trading careers. The study also found that traders who experienced loss aversion had a lower average return on investment than those who were less affected by this bias. In addition, the study showed that traders who experienced loss aversion were more likely to hold on to losing positions, leading to more significant losses over time. Now let's look at some statistics that highlight the impact of loss aversion on trading. According to a study by Fidelity Investments, the top-performing investors were actually those who had either forgotten about their accounts or had passed away. This may seem counterintuitive, but it highlights the fact that the most successful traders tend to avoid making impulsive decisions based on emotions. Another study by DLBR found that individual investors underperform the market by an average of 4.35% per year, largely due to behavioral biases such as loss aversion. So how can us avoid falling prey to loss aversion? Here are some practical tips. Number 1. Understand the concept of loss aversion. The first step in overcoming loss aversion is to understand the concept. Traders should acknowledge that this is a common cognitive bias and understand the consequences of making decisions based on fear. By being aware of loss aversion, traders can take steps to mitigate its impact on their trading decisions. Number 2. Use a trading plan. A well-designed trading plan can help traders to overcome the loss aversion phenomenon. A trading plan outlines the entry and exit criteria, along with the risk-reward ratio. It helps traders to identify their objectives, manage their emotions, and stick to their trading strategy. By following a trading plan, traders can reduce the impact of loss aversion and make more rational trading decisions. We will be discussing about how to make a realistic trading plan in a later video. Number 3. Set realistic expectations. Another important factor in overcoming loss aversion is setting realistic expectations. Traders should not expect to win every trade or make a profit on every investment. Losses are a natural part of trading, and traders should learn to accept them. By setting realistic expectations, traders can avoid the fear of loss and make more rational trading decisions. Number 4. Use stop-loss orders. Stop-loss orders are an essential tool for traders to manage their risks. They allow traders to set a predetermined price level at which a position will be automatically closed. By using stop-loss orders, traders can limit their losses and avoid the emotional stress of watching a losing position. Traders should ensure that the stop-loss level is set at a realistic level based on the market conditions and their risk tolerance. Number 5. Focus on the long term. Traders should focus on the long term rather than the short term. They should avoid making decisions based on short-term fluctuations and instead focus on the big picture. By taking a long-term perspective, traders can avoid the fear of loss and make more rational trading decisions. Number 6. Maintain discipline. Discipline is essential in trading, especially when it comes to overcoming loss aversion. Traders should stick to their trading plan and avoid making impulsive decisions. They should maintain discipline even in the face of losses and stick to their predetermined exit criteria. Number 7. Learn from mistakes. Losses are a natural part of trading, and traders should use them as an opportunity to learn. By analyzing their mistakes, traders can identify the factors that led to the losses and adjust their trading strategies accordingly. Traders should avoid repeating the same mistakes and learn from their experiences. Number 8. Maintain a trade journal. Keeping a trade journal can help traders track their trading history and identify patterns in their decision-making. It can also help traders identify mistakes and areas for improvement in their strategies. Number 9. Practice mindfulness. Mindfulness is a powerful tool that can help traders to overcome the loss aversion phenomenon. By being present in the moment and focusing on their trading decisions, traders can avoid the fear of loss and make more rational decisions. Mindfulness can also help traders to manage their emotions and maintain discipline. Number 10. Seek professional help. Finally, traders who are struggling to overcome loss aversion may benefit from seeking professional help. A qualified therapist can help traders to identify the underlying causes of their fear and develop coping strategies. Additionally, traders can seek the advice of a financial advisor who can help them to develop a comprehensive trading plan and manage their risks. In conclusion, loss aversion is a common psychological bias that can have a big impact on traders' decisions. By being aware of this bias and taking steps to avoid it, traders can make better, more rational decisions that can lead to more success in the market. We hope you found it informative and useful in your trading journey. Remember, trading psychology is just as important as technical analysis and market knowledge. By understanding and overcoming loss aversion, you can improve your trading results significantly. If you have any questions or comments about this video, please leave them in the comments section below. We love to hear from our viewers and are always happy to answer your questions. Don't forget to subscribe to our channel Mindful Trades Academy and hit the notification bell to be notified of our latest videos. We have a lot of great content coming up that you won't want to miss. Thanks again for watching, and we'll catch you in the next video.